Hi everyone, I'm Jakob Hnatovic, Senior Accountant here at Zhou Agency, but my friends like to call me the tax nerd. Today we will be talking about rental properties. Don't roll your eyes, it is a good subject. For those of you new here, Zhou Agency is an expert in all things tax. We have accountants like me, we have an investment real estate advisor, and we also have a small property management team. So we are very well versed in all things when it comes to investment real estate. All right, let's get started. Today we will be talking about rental real estate 101. Don't worry if you're already a pro at this. We will have more in-depth videos in the future. Today we're just going to lay down the basics. Here's the deal. If you're jumping into the rental property game, Uncle Sam is going to want to know about it. You'll report your rental income on a Schedule E on your tax return. Sounds fancy, but it's basically a tax form where you tally up your rental payments, income, and all the stuff you spent to keep the place running. Think insurance, mortgage interest, property taxes, HOA fees, utilities, maintenance, basically everything. Even that one random plant you bought to spruce up the living room can be expensed as long as they're both reasonable and necessary. Now here's where things start to get a little interesting. Depreciation. If you're thinking,
hey Jake, you forgot about the biggest expense.
Nope, I didn't. I was saving the best for last. Depreciation is the MVP of rental properties. Seriously, it's a game changer. So what is depreciation and how does it affect the tax return? Think of it like this. Stuff wears out. A house, for example, does not stay in tip-top shape throughout the life of the asset. The IRS gets this, so they let you spread out the cost over the life of the asset. For residential properties, that's 27 and a half years. So if you bought a $1 million house, not counting the land, you get to deduct around $36,000 per year for depreciation. Not too shabby. Here's how it plays out in real life. Say you bring in $50,000 in rent, and your expenses like utilities, insurance, bribes to the HOA, just kidding, add up to $30,000. That leaves $20,000 in taxable income. But thanks to depreciation, you could report a $16,000 loss instead. No taxes on the rental income, and you might even get to carry forward that loss. You've just made $20,000 in cash and paid zero taxes. Chef's kiss. You might be thinking,
hey Jake, I'm reporting a taxable loss, but it's not offsetting my W-2 income.
My friend, welcome to the wonderful world of IRS rules. You must be making over $150,000. And guess what? Long-term rentals are considered passive by IRS rules. The reason lies in how the IRS categorizes rental activities. Here comes the technical part. The IRS classifies activities as either active or passive. Income or losses from active activities are called active income or active losses, while those from passive activities are called passive income or passive losses. The key distinction is that passive losses cannot offset active income. Unfortunately, the IRS categorizes rental activities as passive by default, which means your depreciation-induced loss cannot offset your W-2 income. Frustrating, right? If you're thinking there has to be a way to offset my W-2 income with rental loss, you would be correct. We will go into that in the next episode.